Welcome everyone to our December 2022 State of the Market update. I want to thank you for joining us. Wish you a happy holidays and happy Thanksgiving. If you liked the video, do us a huge favor, drop us a quick comment, quick like. We'd appreciate that. But today we are going to take a look at the entire market nationally, see what the prices are doing, what the experts are saying, and give you some context on that. And do a deep dive on our local markets here in Lake Tahoe and the Greater Bay Area.
Thank you again so much for being here. We're really hoping to provide some clarity and really great information for you, despite what you're hearing in the news and online.
So we're going to start off today with a quote from the FHFA. The rate of U.S. house price growth has substantially decelerated. This deceleration is widespread, with about 1/3 of all states and metropolitan statistical areas registering annual growth below 10%. So very interesting statistic. Now, on the flip side, that does mean about 2/3 of our market are experiencing actually over that 10% growth rate. But obviously, we are in a period, no doubt, and have been for the last 6 or so months of a deceleration where we're seeing less momentum in the market. And in certain markets, we are seeing those type of corrections.
All right. Yeah, thanks, Coulter. So less appreciation and less momentum in the market, all due to the rise in interest rates. We've talked about this before on our previous monthly market updates, but if we look at September, this is the most recent numbers that are published, and this comes from FHFA, CoreLogic, and Case-Shiller. 11%, 11.4%, 10.6% appreciation in this country. Now, I know you're thinking, gosh, September is in the rearview mirror, and it is, but this is the most recent data that was published at the end of November relative to home price appreciation on an annual basis. So less appreciation than what we've seen over the last couple of years. We've talked about that being an anomaly in the real estate business.
This is what it looks like graphically. This is from CoreLogic going all the way back to January of last year, showing the rise up in residential home price appreciation. And now this deceleration that we can see here, and I'd like to remind people, appreciation on average across the country is about 3.8%, and here locally in the Bay Area, 7.6%. Tahoe sees very similar trends as well. But in these type of markets, we really want to take a look at what's going on month over month as opposed to yearly. And what I would like to pose as a question is, has our market hit the bottom? So nationally, obviously, we've seen that home price appreciation decelerate in through June, but we've started to see in the last 3 months, July, August, and September, is a slowdown on that depreciation. So we'll see what comes out for October, November. But you know, the CoreLogic look at this is that we might be seeing a slow up. And the question I'd love to pose is, has our market hit the bottom?
And I think Mark Fleming says it best when he says home price appreciation has slowed in all 50 markets that we track, but the deceleration is generally more dramatic in areas that experience the strongest peak in appreciation rates, which we're seeing in San Jose Bay Area and in Tahoe. So the areas that have experienced the strongest run up in prices are starting to see the most pronounced decreases in pricing right now. Makes sense? But if we look at this from a month-to-month basis, I'm going to kind of give you the Case-Shiller look here real quick. And most of the recent numbers as of September, we're seeing negative depreciation across the markets. Now, a slight depreciation in some of these markets, and again, I've highlighted here in red, it's over 2% in Dallas, Denver, and Las Vegas. And in some West Coast markets like Phoenix, San Diego, and San Francisco and Seattle. But no doubt we are seeing that.
That's right. Just like Kelly said, here's what's interesting. If we look at home price movement in the last 2 months in some of the hardest hit markets, and I'll show you these here in San Diego, San Francisco, Seattle, the West Coast markets, where the last month and then what's been most recently published this month in each of those markets, we're seeing less depreciation. So take San Diego here, for example, the month prior, negative 2.8% appreciation, and to this month, 2.1% appreciation, although slight but less. And you can see that trend in each market, which is very interesting. Certainly not ready to call that by any stretch of the imagination, but something we want to pay attention to as we watch this price movement across the country. I think we're no doubt in a volatile market. We've seen a little bit of relief in interest rates, some good news coming about inflation, until job reports came out Friday. a little better jobs report than I'm sure the Feds probably would have liked to have seen. But the average 30-year fix right now is 6.49%, just below the 6.5% according to Freddie Mac. So no doubt we're in a volatile market, but we'll see what happens moving forward. I think it's a little too early to say right now that we're kind of out of the woods.
All right, thanks, Coulter. And as the Federal Reserve continues to move interest rates higher, mortgage financing continues to be more expensive, and housing becomes less affordable. Given the continuing prospects for a challenging microeconomic environment, home prices may, well, continue to weaken. So what he's talking about here is all of this is about inflation. We've been talking about that, right, over and over again. And what the Fed is doing is raising the Fed funds rate to combat inflation. Now, going into December, they'll meet again, and the likelihood is they're going to raise the rates. Now, there's nobody saying that right now they're not going to raise the rates, but the question is by now, how much at this point? And I think the larger rate increase could have been signaled by the jobs report on Friday, but we'll have to wait and see what happens there. But there's no doubt that this is going to influence mortgage rates as we go through the month of December. It's going to cause panic, it's going to cause uncertainty, and it's going to cause people to say, okay, what's going to happen as we head into the new year? And I want to give you a little perspective right now. We've always covered the forecast for home prices, and anybody that's calling for depreciation to appreciation across the ones that we track. But if you were to start to put things into perspective, if prices were to drop by a certain amount, and I want to give you this, it's very, very interesting. If prices were to drop by 5% nationally, that takes us back to February of this year. 10% would take us back to October of last year, and you can see the rest down to 25% of October 2020. Now, nobody's calling for that, but I just want to give you put this into perspective on home price appreciation. I think this is something that we need to bring to those that we're working with. Maybe even those that have bought homes in the last couple of years that are wondering, okay, was that a wise decision?
So we'll give you one last slide before we wrap up here. And do let us know if you have any questions about any of the material we've covered, local market, national. We'd be happy to chat with you a little bit further. But our last slide here to look at home price appreciation pre and post pandemic, depending on the city that you're in. This is a great perspective on home prices and where we're at right now to really show you, hey, here's where we were at during the pandemic, and a look at, prior to that from 2017 up to 2020, where the start of the pandemic was. Just to give you a little perspective and to give some of our clients perspective as well. Next month, we will be doing a deep dive on 2023 price forecasts, so stay tuned for that. And for now, we will dive into a little bit about what we're seeing in the headlines. They're doing a little bit more here to terrify than they are to clarify. So we want to dive into that, and I'll let Kelly kind of take it away with some of our newest headlines we're catching.
Debt, consumer debt, real estate debt being talked a lot about in the world right now. And I expect that it'll continue to be talked about as we go through the winter, certainly as we continue to navigate this market. So the first I have here is a tweet from Diana Olick. She said homeowners have lost 1.5 trillion with a T in equity since May as home prices drop. And this is referencing a Black Knight study that we use just as a resource that has phenomenal information about a lot of mortgage information, a lot of price and equity information here as well. And what this article basically says is since July, the median home price in this country has dropped just over 11,560 to be exact. And we translated that into 1.5 trillion in equity that's been lost since the middle of this year, technically since July. Now, what I want to do here is I want to put this into perspective for you because that's accurate. But if somebody were to read that, it sort of pretends that this drop in prices that's going to lead to a catastrophic event in housing. And just again, it's simply not true. So if we were to put this into perspective, this is a look graphically at what this means.
Yeah, that's right. So this is a drop in capital equity to 10.3 trillion to where it sits right now in the third quarter, as in the third quarter of this year. And now I want to break that down for a minute. Capital equity, if you remember, is the amount of equity a homeowner can access before they hit that 80% LTV or 80% of the home's value. So if you have $100,000 in home equity, home capital equity gets you up to 80,000. If you put that in perspective, that's still 400 million above where we were last time this year. And here's what's even more important. If you look at 2019 here, in 2019, we were just over 6 trillion in capital equity. We shot up at the height that was over 11 trillion in the second quarter of this year. Now just over 10 trillion. So significant equity in homes across the country. And I don't think a tweet like that from Diana gives us a full picture of just how strong the equity market is in this country.
Now, if you continue on with this, just about equity, First American said this: homeowners have a very high level of tappable home equity today, providing a cushion to withstand a potential price decline, but also preventing housing distress from turning into a foreclosure. The result will likely be more of a foreclosure trickle than a tsunami. Now, in just a minute, I'm going to talk about household debt and mortgage debt as it relates to headlines and that, but no doubt strong equity across the country is helping homeowners navigate this market. Many of those have strong equity. They have very low interest rates. So, according to FHFA, 92% of the mortgages in this country are below 5%. And you are seeing a lot of people say, we're going to just hang in there. We're not going to move. And that's maybe what is preventing some of the inventory coming to the market right now, no doubt, across the country. But very, very strong levels of equity in homes all over the country. So let's sort of transition this to debt, because that's where conversations generally go, right? And household debt is certainly a topic as inflation is bearing down upon everyone. This CNBC article, household debt soars at the fastest pace in 15 years as credit card use surges, according to the Fed. So if you haven't seen the headlines like that, expect to see those and expect to see more of those as the rapid rise in people accessing those credit cards, using that maybe to even bridge the gap in some of their lifestyles right now with this inflation.
All right, well, thanks for that, Kelly. So now to put that into perspective, and that's always what we want to do here on our deep dives, is give you a perspective on where household debt sits and what that means. So if we go back to credit card balances right now, according to the Fed, and this is all coming from the same information, credit card balances are right where they were in 2019. So this here is a look at 2019 to the third quarter of this year. Now, the rapid rise has certainly come on very quickly, and there's a reason for that. And we went through the 2020 and 2021 stimulus money coming into people's pockets and sums of the trillions. So what did we see back then? As you'd expect, we saw balances, savings accounts rise, and we saw less usage of credit cards. So it would make a lot of sense that we'd be on the rise right now. And certainly that's due to the higher inflation being fact, as well as Kelly mentioned. But the perspective on this is we're right where we were in the 2019 levels. So I think as people start to see, well, credit card balances are rising, people are losing equity in their houses, going back to that earlier headline Kelly went through, this starts to create fear. In the same blog that released this information in the New York Fed, the Liberty Street Economics blog, they said this: through delinquency rates, they're talking about credit card delinquency rates are rising. They remain low by historical standards and suggest consumers are managing their finances through period of increasing prices. So certainly credit card debt is on the rise, but very comparable in the range of where we were at pre-pandemic. And we do want to keep that in mind.
Thanks, Coulter. So that was a really good summary of credit card debt. But the other question is, and it always comes up, is mortgage debt. So where is that across the country? Because that brings up the concern, can people afford to pay their mortgages, and how is that going to play out? I mentioned the FHFA stat that many people across the country have a very affordable mortgage. And certainly as the rates have risen, they've said, hey, we're good, but we're not going to move out of this home with a low mortgage rate, right? I wouldn't either. So now life events certainly will cause people to move. move, and a lot of people will make a decision not to move based on that mortgage rate that they have. But if we look at the debt to income ratio of mortgages across the country, we sit at a point lower than what where we've been going all the way back to the 80s. And this is a household debt service ratio for a mortgage as a percentage of disposable income. So you see this, you look across the country, the average of where that debt service ratio is well below the housing bubble. So well below even the 80s and 90s in this country. So mortgage debt is not an issue right now that we need to look at and say, okay, with strong equity, with this low household debt service ratio. And we can have a perspective, we can have a perspective on that as we see headlines, as we see these things that are intended to draw people and sort of make them worry about where debt is at, in this country. And even if we think about the delinquencies relative to mortgage, they're low as well.
Yeah, all great points, Kelly. I will bring in a quote from the MBA. For the second quarter in a row, the mortgage delinquency rate fell to its lowest level since MBA's survey began in 1979, declining 3.45%. Foreclosure starts and loans in the process of foreclosure also dropped in the third quarter to levels further below their historical average. So not seeing this flood of delinquencies, which is leading to, our leading indicator for foreclosures, we're not seeing this flood of foreclosures on the market. If we look year over year, foreclosures are up, but they're near record lows. It's a look at it right here. So as far as the third quarter, there have been 88,000 new foreclosures in this country. If you keep on that trend, that equals about 100,000 and 125,000 between those two new foreclosures in this country this year. But to put that in perspective, you can see there in 2019, there were 278 foreclosures in this country. So certainly more than 2021 because there was the moratorium for foreclosures. We're seeing more this year, but nowhere near something that sounded the alarm. And we've got issues coming right now staying on top of the headlines, staying on top of what's happening with debt, with certainly foreclosures, with equity. That's what we need to do right now.
And no doubt, these are topics that as we go through the next few weeks, people are going to be gathering in different holiday gatherings in the family, and these topics will come up. And we just want to make sure that you're armed, with the answers or high level overview of the market and what you need to do. And I really think as we navigate this market over the next few months, it's really going to become increasingly important to do that. And if you have, and what we wanted to do next is really kind of take a high level overview of, the local markets, starting with Santa Clara.
So thanks for that, Kelly. As most of you know, we do now service the greater Bay Area and the greater Lake Tahoe area. So we do want to take kind of a 25,000 square foot view and take a look at both markets. We'll start here with Santa Clara, which is kind of our bigger county in the area that we can take a look at. As you'll see here, our price per square foot is down about 11%. As we've looked at in some of our previous videos, we know that our average correction is around that 10% mark. And an interesting correlation between price per square foot and the inventory levels. As you know, we've seen a little bit of stability for these prices as inventory levels have dropped, as is reflected here in the data. But it's an interesting correlation between the price per square foot and inventory levels. So we'll see what happens in the coming months as we move into, through the winter season and into the listing season as spring comes around. And see what happens. But right now, 11% down in our market, starting to see those prices flatten out a little bit.
Yeah, and just to kind of piggyback off that into the trucking market now, prices per square foot are down 16% from their highs. And like Coulter said, there's a direct correlation with the amount of inventory we have to the price per square foot. As you'll notice, the more inventory we have, the lower the prices are, and the lower inventory we have, the higher the prices are. Heading into the winter months, into next year, it'll be really curious to see what that market looks like. There's a lot of talk, but we'll take a look. And again, really, we want to thank you for joining us today on our monthly deep dive. We hope you found some value. If you have any questions, like Coulter mentioned before, please feel free to reach out to us. Call, email, like us, hit that subscribe button so you don't miss any of our future videos. And we hope to see you next time.
Thanks for joining us. And again, if you don't mind throwing us a quick like, quick comment, we'd love to hear your feedback on the video. We do appreciate you sitting down. And if you do have questions, like Kelly said, feel free to reach out. We'd be happy to dive into this data even more in depth in the future. If you would like a deep dive on your local market, do reach out. Our information is on the screen, wherever we're going to put that. And hope to hear from you soon. Thanks for joining us.